The less you do up front, the more money you need to have on hand. The more you do up front, then you can start to mitigate what your potential big problems could be down the future.
Yeah, I have a question. I was thinking about, I just kind of want to know your history. Like, what put you in a first day situation? I know it's kind of hard to see now, but if you were starting your wholesaling career like today, and say you had a little bit of capital, what system would you implement and what tools would you use?
That's tricky, man. I'm really going back and forth because I would still recommend probably starting on a MLS initially, because you can start to get your footing together and you're not wasting money on pulling lists and running marketing and right. It can be very capital intensive up front when you start an off market wholesale business, and you can start burning through capital really quick. And it can literally take you months before your marketing start hitting, and you could be spending several thousands of dollars a month. So I would say I would first go and try to, acquire deals from the MLS and wholesale that way. Cause it's not like all of the opportunities are there already, right? So it's not costing you any money to figure that piece out. And then you're going through the same mechanics of, going and build your buyer's list. Right. But you're not having to necessarily go through spending money to get your seller. Right. So for instance, let's just say you started pulling lists and, you spending let's just say $5,000 a month. And that's getting you, by the time you get, all of these different various addresses off from the list and you start skip tracing and then cold calling these individuals, from that, maybe only get 2 leads per month out of that list, right? But you only got 2 people to choose from, right? That's an actual lead that you could potentially, get their property. So for me, I would recommend, really, really starting off on the MLS, getting the mechanics and the nuance of all what goes into it. And then probably even getting a couple wins and then pivoting and going off market. That would be my recommendation.
I just wanted to know, like, once you get this property and, say you get insurance on the property or whatever, how much capital do you need for something like a multi-million property? You don't have to tell me the price, but maybe percentage, like how much cash, how much capital do you have to have just sitting there just in case for problems? Like, I was just thinking when you said everything was under one roof, I was thinking of a plumbing problem the way through all of them. And so I was like, yeah, how much capital do you got to have to, on the side for problems? So that's one of the questions I had.
Okay. So first let me clarify what Bruce was asking yesterday. Cause while I think the implication was that it was a multi-million-dollar property, also it was a multi-family property. So it was a 72 unit apartment building that he was referencing, in his question. So, I've had, from an insurance perspective, so insurance gets a lot more complicated when you get into larger multifamily. And the reason is if you have tenants living there while you're doing renovations, then for insurance companies, that's a red flag. That's a super high risk. Now they have insurance carriers, as they call them, markets. They have certain insurance markets that will insure, but it becomes very expensive. So for instance, we bought this 40 unit building and we had like 15 tenants on one side and we were renovating 25 units, like almost $1 million renovation. And the initial insurance on that property was like $56,000 for the year. Right. So then I was able to, find a better insurance carrier once we got further along in the process. And we were able to get that down this year to 24,000. I think it was at least 50% in savings. Okay. So, but it costs, but it's economy of scale, right? Everything costs, and so you'll kind of know that going into it. Part of your due diligence when you acquiring a larger property like that, you'll be going through and having phase 1s done, right? Which is like an environmental inspection. You'll be having surveys done to make sure that you're buying the right thing. You'll be having all kind of inspections done, insurance. So you will know a lot of your soft costs going into it. So you just plan for it. But the question then becomes, does the deal pencil based on where my property taxes and my insurance are? Right? Because you have to take into account those expenses in addition to whatever said expenses that you may have on the property. But at the end of the day, it's relative because it's all math. Either it gives me, even after these expenses, I garner the return I want, or I don't. And so either I got to adjust the purchase price at that point or figure out a way to pull back on my rehab. So then, but you have all of I've been talking about underwriting deals all week. That's the part of it, figuring out all those pieces, and then, seeing, does it still meet your criteria?
But do you have to have like money on the side? Like say the roof goes bad, and even though you got to have deductible money, right? Don't you? So
you definitely want to have cash reserves, right?
Right. So, I just want to know how much cash reserve you got to have. Like,
yeah. It's it's going to vary based on property, right? I personally, I like, and this is after we done capital improvements on the property, I still like to have somewhere between $2,000 and $2,500 a door in reserves, in cash reserves. And in addition to that, I'm still building out cash reserves because every month that we pulling back money from the cash flow, we're still putting another small percentage to continue to kind of stockpile that for the what ifs that will come with deferred maintenance. But, if you buying a property that is more deferred maintenance and you didn't come in and do CapEx up front, which is capital expense, that just means that you came in and did, some type of investing and renovating to the property. If you didn't do that up front and there's going to be more deferred maintenance, then you want to, this is why your inspection, your due diligence process is so important, because you may know, okay, I'm not doing a roof right now, but I'm going to need one in 5 years. You don't want to wait 5 years from now to figure that out, right? That roof could cost you, 60 grand. But where you get that from? You know what I mean? So it's, and that's what I was explaining to Bruce, right? When you start looking at these larger properties, you'd be amazed at how much this stuff costs. You know what I mean? Like, it'll blow your mind what the slightest thing will cost you, because it's economy of scale. So, but even looking at single family, you definitely want to have some cash reserves on hand. It's not necessarily a rule of thumb. It's about what you're comfortable with. But, I would say at least probably 3 months of reserves, if not 6, when you're going into it. And it's all predicated on what work are you doing to the property when you first acquire it. The less you do up front, the more money you need to have on hand. The more you do up front, then you can start to mitigate what your potential big problems could be down the future. If I know I got a roof that I got to replace in 5 years, more often than not, I'll just replace it. We'll just put it in the scope initially, and I just get it done from day one.